Good morning, one and all, and welcome to today's video. So today I have two pairs on watch, and those are Sugar USD and Pound Dollar. So I'm going to break them down for you now, give you my thought process, and then tell you what I will be looking for from these pairs as always. So I am going to start off with my favorite of the bunch, which is Sugar USD, and I'm going to start off on the weekly chart just to show you that we are at this overall high area of value. The last time we were up in these areas was back in 2011. You can see that we got to this area in April of this year, and then we've scooped back round almost for that kind of double top that we look for. So we're at a significant area of value for a sell, where a lot of the buyers who've caught this move to the upside will be getting out of their positions. Okay, this is a very high area of value for a sell, and where I would expect the buyers who caught this move to the upside to be getting out of their positions. So if we just zoom in, you can see, if I'm just going to move this over slightly, you can see that although this candle has not closed, this red candle here, we have reached this area. So let's just break this down. Let's break this piece of structure down. So we have this high here. We come all the way back up and we get to that area, but notice we wick to it and we don't wick through it. Okay, on the higher time frames, I talk all the time about how we typically break above before pushing to the downside because of the fact that the media gets hold of the fact that sugar is at a 6-month high or whatever it is, and then people think it's just going to keep going. So when it breaks above and the media report things like sugar at 6-month high, people think it's going to keep going, so they start buying it, and then that's why typically we see people caught the wrong side of the market and it pushed to the downside. More often than not always, but more often than not. And one of the clues that we were likely to do that is the fact that when we did wick to this area, we did so by way of a bullish candle with a green wick above it. So when I say a bullish wick, I mean a bullish candle with a green wick above it. So when we get that at an area of value on the higher time frames and it wicks to it and not through it, it's likely that we'll scoot back up again and fill that wick, okay, before pushing to the downside. You can see that happened again here. We have this bullish wick. We wick to the area, not through it. We push down, so it's likely we'll come back up. We do come back up, and this time we do wick through the area, but we do so by way of a very bullish candle with a green wick above it. So it's likely that we'll fill that area again, and we do fill that area again. And you can see we tap into it, and this time, of course, this candle hasn't closed, but this time we have tapped into it, and this time we have a bearish wick. Okay, we have at this moment in time, we have a bearish candle with a bearish wick above it, and that is more often than not when we see the bigger moves to the downside. Okay, so there's a lot to. One of the reasons I like this is there's so many factors that we who trade the Falcon strategy look for within this piece of price action. Initially, it can just look like mess, but when you actually analyze it, if you have a clue what you're doing, then there's lots and lots of factors. And even on the daily chart, you can see that we got to this area, we wicked to it. This time we did so by way of a bearish wick, but again, we didn't wick through it, we wicked to it. We then come back up, bullish wick, we come back up, fill that, but we do so by way of another bullish wick. And in this instance, this is where it gets quite interesting to me, because we have the things that I'm paying attention to here is, first of all, this. Okay, so we have this impulse correction continuation. That's typically how the market moves. So we typically measure the continuation out of an impulse correction continuation tends to be of a similar length to the preceding impulse if it's a completed structure. So we have an impulse correction continuation because the volume built up within the correction can dictate how far the continuation leg out goes. We also measure it from the break of the correction as well as the base. So what do I mean by that? I mean, if this is the structure, you can see the 1, 2, 3, the 3 drives. We also have that middle section, 1, 2, 3, where they're of the impulses within that are of a similar length. So this gives me a clue that this is a completed piece of structure. If we measure the impulse out from the break, that takes us up to here. Look where price stalled. Look where price is rejected from, folks. Almost exactly there. So these measurements I'm doing, although they're crude and not with any particular measurement tool, look where price stopped and rejected from exactly there. Okay, so that's one thing that I'm paying attention to. So I'm going to delete that for simplicity reasons, and then we can measure this. Of course, we have this impulse here within this impulse correction potential continuation, but notice that we don't get the correction at the end of this correction. We get a reversal structure. Okay, we get this ascending structure here. Of course, if we were to measure the impulse correction continuation there, of course, it's going to be of a similar length because they both started from the same point. Within that, we have a middle section. Okay, so we have this 1, 2, 3 touch structure. This middle section within that, where the impulses are of a similar length. We could measure it from the break as well, from the break of this correction, but we've done enough. Okay, we don't necessarily need to fill that. We have a impulse correction continuation. That's more than enough. If we just zoom in slightly further, so we have this here. We have this impulse correction continuation there. Look where it stopped and rejected, folks, from exactly where this bearish momentum started. Okay, so these are not, I'm not randomly doing this. There's mathematics behind this. If we measure the middle section, the 1, 2, 3 middle section, giving me a clue that this is a completed piece of structure. That's 90%, almost the exact length of the preceding impulse. In this instance, we don't really have I mean, you could cut through the wick like that if you wanted to. I've just got it here. We don't always need a first touch. We just need those 3 drives, and you can see we have that 1, 2, 3 drives. And within that, we have a 1, 2, 3 last leg. Okay, if we measure that impulse correction continuation, it lines up perfectly with where price rejected from. So in terms of structure and how we look to trade, there's so much about this. Is one of the cleanest structures and cleanest examples of how we trade that I've seen. So with that in mind, I will be looking for today. So there was I believe there was a little entry here that you could have taken. So we had the push down and the correction. Okay, and if we just analyze that on the 5-minute chart, yeah, one of the reasons I didn't, you could have taken this because technically you do have a 1, 2, 3, and you do kind of have this 1, 2, 3 middle section. One of the reasons I didn't take this is because if we just zoom out, I was looking at this as a potential a move to potentially come back up, right? Okay, so we have this sharp move down followed by this sharp move up, and I saw this as potentially being the base of a 1, 2, 3 touch structure, where we have this 1, 2, 3 middle section where it breaks below, pushes up, and then we go, and then this becomes the middle section. And one of the reasons I thought that is because I couldn't see a middle section within here. I couldn't see a clear idea. And one of the things that I've noticed is that often if you can't see the middle section within a piece of structure, you might be trading in the middle section. So at the time I was kind of seeing this as a structure here, but I couldn't see the middle section within here. So I was kind of seeing that potentially this was the middle section, and which would mean that if I was to get short on the break of this correction or within it, then I could be tagged in, tagged out, price pushes up, and then we move to the downside. So I was just seeing this as kind of a higher risk trade. And by that, I mean, by higher risk trade, I mean a trade that could potentially turn into something else. One of the questions I ask myself when I place a trade is, could this turn into something else? And the answer is yes. So therefore that makes it a higher risk position. Okay. But now you can see we've broken below these lows. We've broken below both of these kind of sharp hook points there. So that has negated, and we've corrected below that. Okay, we've corrected below that. So then that, in my mind, negates the possibility. Price did not find enough liquidity here at this area to push it back up. So then that negates the possibility of this pushing back up and this becoming the middle section. Okay, so with that in mind, I'm now happy that this is a completed piece of structure, and that we're not going to create a little ending structure, which is what I was explaining to you then there a moment ago. So what I'll be looking for, is for price to correct. If we correct sideways, I'm just going to remove that off the chart because that doesn't need to be there. Okay, there we go. It's gone. So if we correct sideways and we get a correction like this, this may act as the footprint. So by footprint, I mean, see this high here. It is a bearish wick, so it doesn't necessarily need to be filled, but we may come back up. This may act as the footprint where we get that kind of something like that. And if we get something like that, it may form further down. It may not form at all. Okay, so we have to be neutral. But if we form a correction, so one of my rules is that, as well, just to touch on it, one of my rules is that I don't start looking for flags. So on the 15-minute chart until we have so when we have a bearish move down like this, where it's all red candles, I don't look on the 15-minute chart for entries until we've had a bullish close, which is like a correction. So when we have a green candle, that gives me permission to drop down to the 15-minute chart to look for entries, and notice that we didn't have that. That's the other thing, just to touch on. It's all been red candles, so I've been waiting for a green candle to close so that I can see, yes, that opens the doorway that gives me permission to look on the 15-minute chart for corrections. So if we get that green candle, okay, and price starts to correct, then I will look to get short on the break of the flag or within it if we get one, and then I will be able to manage this down to these lows for something in the region of 5%. And of course, if we push down to the base of this structure, then that would be about 10%. And of course, we could push lower because we have a near miss to this area here. We may push lower, and if that's the case, then obviously it could be all systems go. Whether we catch all of that in one go is a different matter, but that is what I'll be looking for from Sugar USD today. So moving on to pound dollar. Pound dollar on the higher time frames. If we just zoom out to the monthly, we had that structure that I was talking about. We had that the overall 1, 2, 3 touch structure with a middle section in it, with the lengths within the middle section, as you can see, without me even needing to measure it, are of a similar length. And we have that 1, 2, 3, where in this instance the impulses are, the final impulse is longer, but we know why the final impulse is longer, because price broke below a standout area of liquidity. You can see that according to my data, at least, price never reached it. This was the first time that price had ever reached values below this value here. Okay, so price had never broken that low before. People hear the media narratives, they think it's just going to keep going. I don't really know what I'm doing, but it's just going to keep going. So they start selling, they get caught the wrong side of the market, and then price pushes back up. You can even see here, if you just analyze this on the weekly, you can see where they thought this was a retest, it comes back up. They think this is a retest, so they start getting short, and then they get washed out. We see the same thing over and over again. So on the higher time frame, because this is now a completed piece of structure, I'm now looking for that impulse correction potential continuation to push higher, to take out this near miss, which which failed to tap into this area of value last time around, making it more likely that we will push up to that area. But on the lower time frame, we have a potential counter trend move in the other direction. You can see that we have this 1, 2, 3 touch structure here, where we have that 1, 2, 3 middle section, giving me a clue that this is a completed piece of structure. Of course, price breaks out of that and pushes to the upside, but it leaves a footprint in its wake. Okay, so by footprint, I mean we have, if you just zoom left, look at this little sharp move down followed by a sharp move up. That gives me a clue that there's potentially liquidity here that needs to be filled, and one of the things that makes me think that is that we near missed to that area and moved up in a very non-progressive manner by way of this structure here. Okay, it's also, just to touch on it, it's kind of the retest as well of the break of this structure. So we have this structure here, we have that 1, 2, 3 middle section, we break out, we come back down to retest that area before we go. So this is an area of significance as well. It's not just a sharp hook point, it's where price broke this structure. So then you can see, if I just zoom back out on the daily ever so quickly, you can see that we've tapped into an area of consolidation here and we've pushed down. Notice that we did so by way of a bearish wick, not a bullish wick. So this doesn't necessarily need to be filled. Okay. These are all things I'm paying attention to. We had and a good example of that is that we had a bullish wick here on the 4-hour chart. What happens? Price comes up and fills it, but it fills it by way of a bearish wick, okay, and then pushes down. What a coincidence. Okay, so these things that I'm saying, there's evidence behind them. They're not just made up. Okay, so within this non-progressive price action, we have a 1, 2, 3. Have we fulfilled the impulse correction continuation? We have. Why did we push a bit higher before pushing lower? Probably because there was a sharp area of liquidity here, which price sold off from aggressively last time around, meaning that there was probably a lot of liquidity here. Okay. The other reason is that we have this middle section here. We have this 1, 2, 3, where the impulses within that impulse correction continuation are of a similar length. Okay. So we can measure them. Whoops. You can see they're of a similar length. Also, if we measure the height of the middle section, okay, so if we assume that the middle section is a structure within itself, and we have this like so, if we measure that, the height of it, so we're measuring it from where it broke to the base, and then we measure, we assume that the impulse out of it, because of the volume that's been built up, is of a similar length to the height of the correction itself. Look where that takes us. It takes us up to bang on where the area of value is and bang on where price rejected from. Okay, so I don't know what's going to happen in the market, but I use these measurements and these structures that we look for to give me a high, an indication of what is highly likely. Okay, so you can see we also have a near miss to this low and a near miss to there, making it the more near misses we have below price, the more likely it is the price will push down to take out those near misses. And you can see there wasn't actually a way, there hasn't so far been a way for me to get involved according to my rules, but you can see now price is starting to consolidate. Okay, so it wouldn't surprise me if we got something like this. This doesn't, we've come from an impulse up followed by a correction, so that gives me a clue that we might get an impulse correction continuation. It also, to the top of this structure, it also gives me an indication that we may get something slightly larger. Just looking at when I'm looking at these corrections, I'm also looking at the proportion of the correction relative to the impulse down which has preceded it. So it wouldn't surprise me if we push up, near miss. Okay, we see these a lot. We don't always near miss, but if we near miss to this area, we get that 1, 2, 3 middle section, we push back up, and then we tap into that high. It wouldn't surprise me if you got that, and that would be where I would typically look for a risk entry. So within the flag. Okay, so we have risk entries within a flag, or we have reduced risk entries on the break of the flag. And if we just look at that, that's what I forecasted last night. So if we get something like this, this is actually a reduced risk entry on the break of the flag, for those that don't know. To me, it's looking a little bit less likely, and it's looking more likely that I would take a risk entry within the flag such as that. And if I did, I would be able to get 10% down to this first notable target, which would be here, and then of course it would be 12% down to the next low, and then potentially about 13% to the low thereafter. If I did take a reduced risk entry on the break of the flag, even then I'll be able to manage it for something in the region of 4 to 5%. And of course, if I was trailing my stop, I would, once we got down to here, I would trail it a bit more aggressively if we broke that low, and even then I would be, if I was trailing it above that low, I would still be running at, say, 3 to 3.5% profit. So that is what I'm going to be looking for, folks, from pound dollar today. I hope you've enjoyed this video. As I say, these structures are pretty textbook, particularly sugar. I do like that. But as I say, it's not about being right. But if you understand price action, you don't need all this. Hopefully, you've seen enough of my videos now to know that you don't need all this garbage that they give you on the chart. Sorry, TradingView, but a lot of these things are not necessary. And the reason brokers like you to use all these indicators and moving averages, stochastics, MACDs, RSIs, all the rest of that, jazz, is because they know that, typically speaking, it just confuses people, right? And when you're trading a £1 million account and you go on a bit of a losing streak and you don't know why, because you don't actually know how to read price action, so you therefore don't know what it's doing, then that's going to cause you anxiety, which is going to cause you to give back some of the profit that you're making. And that's what the brokers want. although they won't tell you that. Anyway, that's a story for another day. Thanks for watching, folks, and I'll see you again in the next video.